Welcome to Every Dollar Counts with Josh and Jay, a shot of true serum for your investment and insurance questions. I'm Josh Knoll, the owner of Gulf Coast Financial Advisors, and I'm joined by my co-host, Mr. Jay Stubbs, Director of the Gulf Coast for First Protective. We are brought to you on the Prime Capital Investment Advisors podcast network. Well, Jay, we got to welcome him back an episode ago. Very special guest. He's our first returning guest, which means we didn't scare him off, and also means that he came in and crushed it. So listeners, if you would please welcome back to the studio Mr. Will Steih. He is the Managing Director of the Tennessee Office for Prime Capital Investment Advisors. So, Will, how you doing, man? Second episode back in.
I'm well. Thank you so much for the return invite. Feel privileged to be a repeat party.
Well, listeners, you may recognize Will from our Boss series that we did several months ago. That was the Business Owner Strategies and Solutions campaign, where we discussed the planning needs of successful business owners. With that Boss series, I think it's fair to say that one, I learned a lot. Mr. Big Brain over here, Jay Stubbs, in the co-host seat, already was coming to the table with all this knowledge. But, Mr. Guy off the street here, Josh Knoll, learned a lot about business owner, ESOP, non-qualified deferred comp, all those things. And listeners, if the business owner strategy kind of appeals to you, if that terminology appeals to you, I highly recommend go back in time and check out those episodes of Will and then come circle back around to this one. And also what the Boss Series really planted the seed was an opportunity for Will and I to further our relationship and join forces under the Gulf Coast Financial Advisor branding down here along the Gulf Coast. So, Jay, Will, as we lay out the topic today, the title is going to be Wealth Transfer Planning. Now, that's a big word. And for anybody that is actually...
That's three big words.
That's three big words, yeah. As we know from the previous episode, I sometimes struggle with big words with too many syllables in them, but I was able to get that out. But anybody that is familiar with that term probably immediately starts thinking about, well, what he's talking about legacy planning. He's talking about estate. He's talking about estate tax. Potentially even takes your mind to, he's talking about the death tax. Well, yes, today, listeners, we're going to run through some things that really apply in any generation, in any time period, to someone that has an estate. And as we get into the podcast, Jay is going to describe who is someone that actually has an estate and should be thinking about this stuff. Plus, too, to be fair, we try not to timestamp our episodes, but we are recording this shortly before we know the outcome of an upcoming election. So we're going to kind of steer away from trying to predict what's going to happen and the impact, particularly on the estate tax. But we're going to have some common sense talk around those things that would apply, whether it's Trump, whether it's Biden, or maybe 4 to 8 years from now, whether it's someone else, things that you should be thinking about. So before we dive into all this, though, we're going to have our friends from Sloth Racer kick us off. Jay, bud, how you doing?
Josh, I'm doing great. It's good to be back with you here at Deep Fried Studios, and Johnny and Will. Welcome back to the episodes of recording some of the best podcast content in the world.
Great to be here with you, Jay.
Well, Will, Jay, before we get going, we got to do a quick housekeeping for compliance. Jay Stubbs and First Protective are not affiliated with Prime Capital Investment Advisors, Qualified Plan Advisors, or Gulf Coast Financial Advisors, and Will Steih and Josh Knoll are not affiliated with First Protective. So, guys, we're going to, as I laid out in the intro, we're going to talk about wealth transfer planning. Now, a big chunk of wealth transfer planning, some would say maybe the primary aspect of that terminology is going to be the estate tax. So what we're going to do, we're going to start off with my Mr. CPA friend here, the man that forgets nothing. We're going to talk about a little bit of the recent history of the estate tax and how it's kind of modified itself through different administrations, particularly, again, mindful of the fact that we are looking at the potential of, maybe a further Trump president, or maybe we have a complete change over to Biden. So, Will, I'm going to kick it to you. Can you give us a little bit of recent history of the estate tax, some would call the death tax?
So, as it stands today, here we are in 2020, Josh, and generally when we talk about these terms, we'll be throwing dollar amounts out. And so whether it's if you're married filing jointly, oftentimes you'll hear that amount doubled because a husband and wife each carry this two things are called an exemption amount. And the current exemption amount is $11.8 million. And what that means is at the end of the day, and when you're called out of here, the dollar amount of the things you own is added up. Whether it's real property, it's land, it's a personal residence that you live in, it's an account that you maintain that you've socked away some savings, and it's a 401k account you have at your employer or an IRA. The sum total of all the things that you own is what's added up, and if those dollar amounts exceed the $11.8 million, they are subject to a tax rate of 40 cents for every dollar above that amount. Now, the history lesson there I think you were trying to prompt me on, Josh, is that it wasn't that long ago. It was just recently, back in the Trump tax bill of 2017, increased. It actually doubled where we were at that stage of the game, which was roughly $5.5 million. So we went from $5.5 million to $11 million with a stroke of a pen. The same tax rate applied to 40%. And my comment would be there is, folks, that was good news then. So if anybody had done the proper planning like we would want to structure it for them, and was saving for retirement, doing all the things that they need to do, and they were a business owner that had grown up a company over a 10, 15, 20-year period, that was a big relief to realize, wow, okay, we just took a big swath of folks that were in that $6 million to $10 million range, and they thought they no longer had to be concerned about it. But what, just as easily as I say this, with a stroke of a pen, it was a, if you will, good thing. It went up. Folks, just by a stroke of a pen, it can reverse course. It could go from $11.8 million back down to where we were, $5.4 million. As a matter of fact, as we look forward, under the current Trump tax bill, that would sunset in December of 2025. So it will revert. Now, whether it reverts faster, it remains to be seen. This election that's on the horizon could cause for that to change very quickly. And
for those listening, it wasn't that long ago, Will, all the way back in the late 90s, that the exemption was only $600,000. So everything you owned above and beyond the $600 amount was then taxed, and back then it was at a 55% tax rate. So there's a lot. The swing here over the last 23 years has gone from $600,000 exemption to now $11.8 million exemption, and all of that has been with strokes of pens.
Yeah, very good. Well, Jay, let's talk about this. Will just threw out some big numbers. I mean, to be fair, we don't have old Glenn Spencer here in studio where these big numbers don't seem to rattle him as much. But 5.5 million, 11.8 million, these are reasonably sizable numbers, right? So Jay, what I'd like to ask you is, somebody listening here and saying, well, gosh, I've got a business worth $1 million and maybe $500,000 in the investments or the bank, or where it may be. Should I keep on listening, or even dial a little bit further down? Somebody with a nice W-2 income has a home. What is a definable estate? Does everybody have an estate, or is it we only talking to a very sliver specific part of the market with this podcast?
Yeah, if you are a owner of any assets and then you pass away, you have an estate. That's the bottom line, whether it's $1 or $1 million or $100 million. The things that are in your care, custody, and control the date of your death will be transferred to your spouse by way of your will. Those are the things that everybody has to calculate, and it doesn't matter how much it is. So you still have to plan for the estate. Now, people that have amassed certain wealth and are starting to listen to some of these exemption numbers, remember, the basic goal, the number one goal of estate tax planning is to transfer as much of your property with as little taxation as possible. And there's a lot of codes and a lot of rules within our tax code here in this country that allow for us to sit down with advisors like us, you, me, Will, and have a discussion about the things that we want to move on to the next generation. As you stated at the beginning of this podcast, it's the legacy that we leave. Some people listen to this podcast may say, I don't really care about leaving a legacy to my next generation, but I'm real big on a 501c3 or a charitable entity or a church or a school. That still requires planning. So everyone has an estate. Everyone needs a plan, and without a plan, the federal government and your state government and your local government will have one for you.
Very good. Well, all right, so Jay, to further on that note then, let's talk about what typically makes up an estate. A lot of times we're looking at real property, we're looking at real estate, also looking at investment assets. Now, most folks that listen to the show are going to be familiar with what is defined as a non-qualified account versus a qualified account. But would you mind to walk the listeners through some of the differences in how those holdings are when it comes to passing on your legacy?
So we talked about this in our latest podcast episode, the one right before this, on step up after someone passes away. You can review that episode when you're ready. But qualified means it hasn't been taxed yet. It's usually earmarked in our 401k and our IRA assets. And then non-qualified, it's already been taxed, and it potentially could get a step up in basis. So those are the things that we own. Very basic. A house is a non-qualified asset. a IRA, 401k plan, anything that's not been taxed yet is considered qualified asset. The federal government has rules established for us on the qualified money. Now, it just was enacted that, hey, you're going to have this qualified money. If it goes to a child, one of your son or your daughter, then you're going to be forced into a 10-year stretch of that qualified asset. So
what's that mean, Jay?
All right, so if I've got a $500,000 401k and I'm married, my first beneficiary is my wife. So my wife would get that asset upon my death. If she then dies, her beneficiary on that asset is more than likely going to be one or all of our children. When one or all of those children inherit that 401k or that qualified asset, they're going to force the federal government, the Department of Labor says you've got to take all of that asset out over a 10-year period. You can do it in year one, you can do it over time, stretch it out over a 10-year period, or you can do it at year 10. But remember, qualified money has not yet been taxed. So they want to get their taxable revenue. So that money, when it comes out, whoever draws it out is going to be paying tax on it. That's a big deal. It used to be we could stretch it out. If I'm a son or a daughter and I inherited a 401k or an IRA, I could stretch it out over my life expectancy. Now I'm having to do it over a 10-year period. Let's put that to real numbers, and I'm going to turn it over to Will here in just a second. If I inherit a father or a mom's $500,000 IRA and I let it grow over a 10-year period, let's say it gets a conservative growth rate and it maybe doubles over that 10-year period to $1 million. If I draw out $1 million, I'm paying $1 million. That's a hit to my taxable income in that year. That's a big tax in that time frame.
Absolutely, and it's the thing we see more often that. And again, there's two different perspectives here. There's the perspective of the person that is passing down this asset, this not qualified is specifically what we're talking about. But it really, when I present this to the person that actually owns it, the person actually that scrimped and saved and years of that account balance represents a whole bunch of saving. It's maybe employer match from the company where they worked. Then they hand it downstream. They're not the details and the statistics by those who inherit. Oftentimes, they're not even going to wait that 10-year period. It's like, hey, this is like found money. This is great. Hey, let's do it. And they take an entire withdrawal out. Let's use your example of $1 million, Jay. In today's tax rate, that's $370,000 is gone from that IRA that you intended to pass down. So somebody said, boy, that really rubs me the wrong way, Will, to think that my son or daughter just might do that. And they were uncertain about it. So there's some planning techniques that we can use to try to mitigate that. How quickly can they have access to it? How quickly are they able to drain it, if you will, and incur all these taxes? Certainly we used to operate under an idea about stretching it out over a lifetime, which could be 40, 50, 60 years. But now, due to the changes, we're having to be more careful in our planning. And ultimately, we really want that IRA owner to get satisfied with what the plan is for them to reduce taxes.
I like to tell people, avoid erosion of your qualified money when your children inherit it.
Say that again, Jay.
Avoid erosion of your qualified money when your children inherit it. Either make plans to spend it or make plans to protect it. Either way, you better have a plan.
I like that. Well, all right. So previous in this episode, Will Steih did a little brief history or recent history of the estate tax exemption. Will, as the elder statesman of this Every Dollar Counts podcast that we have going on, sorry, I had to tease you a little bit. The point being is you have helped people in your role as a financial advisor, you're with your CPA background, you have helped people through legacy planning, estate planning, through several different administrations. Is that fair?
Correct.
Okay. Now, so you can walk the listeners through a little bit on something that potentially could have been kicked down the can kicked down the road a little bit for some people and with certain levels of financial planning. What's been the conversation recently around the need for wealth transfer planning, and definitely with the uncertainties that face us, what do you think what will the conversations look like as the years continue to roll along?
So what can I do now? Like, what is an actionable item out of what you're listening to on this podcast is to consult with a qualified advisor. We certainly would welcome that inquiry from you. But what is happening, what is actionable is for the business owner, she and her spouse is to consider uses of trust. So if we say that the future is cloudy. It's not really certain. Some things you can make certain of, and that is to go ahead and take advantage of the current exemption amount. And if the current exemption amount is already at $11.8 million and it is already slated to fall for sure in 5 years, then, well, why not go ahead and take use of that exemption amount, as we might say, book it, make provisions for in legal documents that a qualified estate planning attorney will assist, and we will help quarterback that process. That then you will, regardless of what happens in the future, you'll already have taken steps to take advantage of that, because ultimately what we're saying here is if the $11.8 million drops back to 5.4 and you haven't used it yet, there's $6 million that just went out the door. $6 million now subject to that current rate 40% tax bracket. That could be a $2.4 million decision by failing to take action, by failing to move forward. Is there any downside to it? Well, some attorneys would say, well, you know what if it turns out that Mr. and Mrs. Business Owner didn't need to take those steps? And I would say, well, if planning properly, it's not going to hurt you. It will not harm you. When people think about trust at times, they get a little bit concerned. Well, does that mean I'm going up to the big bank on the corner and there's some guy in a three-piece suit behind a desk that I have to ask questions about to say I need access to some of that money? The answer is no. The answer is that is absolutely not the case. We're going to structure it in such a way that, quite frankly, in some cases, we'll even use the spouse. There's a mechanism known as a spousal lifetime access trust, which can provide for spouses to basically give one another the exemption amount and say, hey, listen, I'm with you. We're here for the long term. You take care of this. I'm going to take care of this pot of money. And we're going to go forward and basically carve off that, in this case, roughly $24 million from Uncle Sam and any future growth. That's the other important aspect of here, particularly with assets that grow. We're going to freeze it, and we're going to protect the future growth from being subject to those estate taxes as well.
Very good. All right, so I got one last question for both of you with your experience. And to be fair, Will, I was teasing. I mean, I'm pretty close to your age, right? So is that fair?
Well, if the shoe fits, but no, you're right on my heels there, pal.
I'm right on your heels.
And I'm right on yours.
Yes, yeah, we have a cascading thing here going, but we're all in the prime of our lives. That's what my dad tells me. So what I wanted to ask you, Jay, and then Will, if you want to chime in, we're laying all this out as if it's math and numbers on a page, but Jay, is there an emotional component to this whole discussion?
100% emotional. When you start talking about the disposition of the things that you own and your estate and the things in your house and your property and your business interests and all of that, it is a plan process, but it can be emotional to the mom and the dad thinking about, taking those assets and transferring them to the next generation. But it's natural to be emotional about it. It has to happen. You need to have a plan regardless, because remember, everyone has an estate, whether it's $1 or $1 million or more, and we want to protect that estate and not make the next generation have to pay too much in tax in order to enjoy those assets that they inherit. So I firmly believe you need counsel with an advisor, somebody who does this on a routine basis. If needed, you need to get an estate planning attorney involved. If needed, you need to get a CPA involved. And if anybody if there's one thing I'd like to mention here, everybody needs a will, and everybody needs some sort of plan to make sure that the disposition of those assets go where they want them to go.
Very good. Will, any final thoughts? Sorry, Jay, let me cut you off. Will, any final thoughts?
No, I appreciate Jay's sentiment around it's an emotional subject. And oftentimes different people have different challenges with that. But to go ahead and sketch it out, to go ahead and put it front and center, it becomes less of a fear factor, starts to get mitigated there. All of a sudden, the people really, it's going to give you peace of mind. As oftentimes they'll say it's your pillow test. When you go to lay your head on your pillow at night, after you've gone through this process, after you've made and given deliberate thought to making decisions, you're going to sleep better at night to know that, yes, there is in fact a plan in place, and yes, in fact, either the federal government or your local state government is not going to have a say-so, and the people whom you love and intend to have the things you own become theirs. You're going to have a plan in place, and you're going to sleep better at night knowing that you've taken care of this.
Well, and guys, I'll say this briefly, but from personal experience, not having a plan in place, irrespective of the assets, has a potential to rip a family apart. So that I can tell you from personal experience, it's better to have the plan in place, have it ahead of time, get the pain over early. Don't let it fester, and don't let it come back to roost after.
Josh, you've mentioned in all of our shows, if they want to get more information from me, they can visit jstubbs.com. Literally, that is a website that you don't have to log in and get anything from. But if anybody listening to this says, well, golly, do I have an estate or do we need to make some plans? I've got a section of that website that's called Free Life Guides. And Free Life Guides, one of them is planning your estate. The other one right next to it is managing an inheritance. So if you're listening to this and you're the future bearer of an inheritance, go look at managing an inheritance. If you are listening to this and you have an estate that you want to effectively transfer to the next generation or generations, go to planning your estate. And then once you've kind of got your hands wrapped around that, work with an advisor like yourself, like Will, whoever that might be, and sit down and formulate that plan and put pencil to paper.
Very good. Folks, you just heard how to get a hold of Jay. If you want to reach out to Will and I through Gulf Coast Financial Advisors, you can always call us at 251-327-2124, or you can set an appointment and see our resources on our website at gulfcoastfa.com. That's Gulf Coast FAs and financialadvisor.com. So want to first, many thanks to our producer, Johnny Gwynn, and his faithful four-legged friend. We finally figured out it's Jed. Is that right, Jay? Is that what we determined the dog?
That's what I call him.
That's what you call him. Yeah, we've called him a lot of Jay things. We jump around a little bit. We also, thanks to the voice you just heard, my co-host Jay Stubbs, and then obviously a huge thanks to Will Steih for joining us once again, doing a great job with the knowledge he brings to the table. And then, of course, huge shout out to all y'all that are listening. Those that have joined Jay and I on this journey, those of you that are joining us now. Do you like the show? Do me a favor, please subscribe on the Apple Podcast app or wherever you find your favorite podcasts. And while you're there, you would be doing us a huge favor if you would rate and review the show. It helps other listeners like you find us. Lastly, you like the show music? Go check out slothracerband.com. That's slothracerband.com. And they're going to take us home now. This has been Every Dollar Counts with Josh and Jay. Advisory services offered through Prime Capital Investment Advisors, LLC, PCIA, a federally registered investment advisor. PCIA, doing business as Prime Capital Wealth Management, PCWM, and Qualified Plan Advisors, QPA. Gulf Coast Financial Advisors is independent of Prime Capital Advisors. Information presented is for educational purposes only, is not an offer or solicitation for the sale or purchase of any securities. All investments involve risk, and unless otherwise stated, be sure to consult a tax professional before implementing any tax or investment strategies.